In this session, we will move beyond money as a concept and towards the measurement of the total amount of money circulating in the economy. Why do we need to measure money? Well, there is evidence that too much or too little money can affect economic growth, interest rates, and inflation. As a result, central banks and policymakers have paid close attention to the money supply, as well as innovations in money and the payment system. In this session, we will examine the relation between aggregate money growth and the inflation rate in the past 50 or so years. Money is a special asset that we use for payments. It is a subset of our wealth. We use it for transactions, to make purchases or pay down our debts. Money is the most convenient way to pay for things. But of course, we hold our wealth in a variety of other forms. We have funds in bank accounts, we invest in stocks and bonds, and we may own a house. We can use these other assets for payments, but these other methods can be more expensive. Why? Well, we first have to convert the asset into money. This is called liquidating the asset. Asset liquidity tells us how costly it is to convert an asset into money. Cash is already money, so it is the most liquid asset. Some bank accounts allow us to write checks or charge debit cards. These accounts work just like cash, as we all know. We can rank all assets by their degree of liquidity. Cash is the most liquid asset since it can be used right away as a means of payment. Houses and other property, such as jewelry or family heirlooms, are valuable, but they might take time to sell at the right price. So they are considered the least liquid category of assets. Securities and savings accounts with lock-up periods sit somewhere in the middle. We can use this asset liquidity ranking to arrive at a definition of money. There really is no ideal way to do it, and the definition has changed over time. Including only cash as money is probably too strict, and including stocks and bonds is too loose, since people probably don't use stocks to pay for groceries. In practice, economists work with two basic definitions of money, M1 and M2. M1 is the strictest definition. It includes only paper money that is in the hands of the public, that's in our wallets, not sitting in bank vaults, as well as checking accounts at banks. M2 is a broader measure of money. It takes that M1 and adds in some savings accounts. These savings accounts can be located at banks or a type of mutual fund called a money market fund. These are highly liquid accounts, but they are not quite as convenient as checking accounts. For example, bank savings accounts may restrict customers to a certain number of withdrawals per month. Since savings accounts pay interest, households have moved their funds from M1 into M2. This means that M2 moves more closely with economic activity, and so economists tend to focus on this measure. Here's some data from the Federal Reserve on monetary aggregates in April 2020. We have a breakdown into M1 and then M2. M1 includes currency plus checking accounts. M2 is the whole pie, so it adds in the savings accounts. As you can see, if we just focused on currency as our measure of money, then we miss a big part of the picture. That's why economists prefer to look at M2. Let's now introduce the concept of inflation. Inflation captures the rate at which prices increase over time. With high inflation, we must spend more dollar bills to buy the same basket of goods as last month. Put differently, with high inflation, money becomes less valuable. The Consumer Price Index, or CPI, is the most commonly used measure of the inflation rate. It measures changes in the price of the same basket of goods and services: food, housing, cell phones, and so on, over some fixed period of time. In January 2021, the 12-month CPI in the United States was about 1.4%. This means that I would pay $101.40 to buy the same basket of goods that cost me exactly $100 to buy 1 year prior in January 2020. Growth in the CPI tells us about the purchasing power of our money. In the past, there have been several episodes of very high inflation. Germany in 1923, the daily inflation rate was 21%. This meant that prices doubled every 3 days. We saw similar outcomes in Hungary in 1946, Zimbabwe in 2008, and Venezuela in 2018. Why does this happen? The usual observation is that the government finances its deficits by increasing the money supply, by forcing the central bank to print money to pay for its spending. These periods of very high money growth are then followed by periods of very high inflation. When there is more and more money chasing a fixed number of goods, money becomes less valuable. Terrible, dire outcomes for households and businesses usually follow. The experience in the United States, in the 20th century at least, has never been that bad. Here is a plot showing monthly CPI growth from 1950 to present. Inflation has generally been below 5%, except in the 1970s and 80s, when inflation exceeded 10%. This period has been called the Great Inflation. At this point, we're going to take 2 steps. First, let's use our monetary aggregates to examine whether money supply grew before the Great Inflation. Second, let's see if our monetary aggregates can forecast inflation in the 21st century. Here is the relation between inflation and money growth from 1960 until 1980. Inflation is measured using the CPI. Money growth is measured using M2. Money growth is lagged 2 years to make sure we get the timing correct. Does money growth in 1960 have an association with inflation in 1962? And so on. In the graph, each red dot represents a month. So this red dot here represents April 1980. At this point in time, the inflation rate was around 15%, and the money growth rate from 2 years prior was around 8%. The fitted line shows a positive association between money growth and inflation. Periods of high money growth are associated with high inflation 2 years later. Periods of low money growth are associated with low inflation also 2 years later. This fits our intuition. But the story doesn't end there. If we instead focus on the post-2000 period, we lose the correlation between growth rates in M2 and the CPI. M2 is no longer useful for predicting inflation in the 21st century. Why is this the case? There are 2 potential explanations. First, the relation between money growth and inflation does not show up in a low inflation environment. You may have noticed that after the year 2000, the inflation rate is hovering around 2%. That is abnormally low by historical standards. The second possibility is that M2 is no longer an accurate measure of money. In the 21st century, there are much lower transaction costs in financial markets, credit cards are widespread, and new digital payment technologies are popping up every day. The way we use money and make payments has changed quite a bit, and so perhaps we need a new measure of money. Let's wrap up. In this session, we went from the concept of money to its measurement at the economy-wide scale. We used these monetary aggregates to try to understand the relation between money growth and inflation. During the Great Inflation of the 1970s and 80s, we saw that money growth was also elevated. Finally, in the 21st century, we saw this relationship became murky. This raises questions about how we should measure money in the future. It also cast doubt on whether past approaches by governments and central banks to control inflation will be effective in the future.